Welcome to Market Insight Cast on YouTube, your go-to destination for comprehensive financial deep dives and market analysis. All right, let's unpack this. Welcome to the Deep Dive, the show where we take a stack of your sources, extract the most important nuggets of knowledge or insight, and, well, give you a powerful shortcut to being truly well-informed. Today, we're embarking on a major deep dive into one of the absolute biggest tech giants out there, Meta platforms. We've gathered a fascinating array of materials here covering really everything from their intricate core business structure and expensive product offerings to their latest financial reports, their audacious future strategic bets, and even, the regulatory headwinds they're facing. Our mission today is crystal clear: to thoroughly explore Meta's current landscape, dissect their ambitious future investments, analyze their financial health with, like, a magnifying glass, and ultimately understand what all this really means for their trajectory, their challenges, and, their potential in the years to come.
You're going to walk away from this deep dive with a comprehensive, nuanced understanding, ready to tackle any high-level discussion on Meta with genuine insight. And as always, we're going to explore this from multiple angles, like looking at a diamond from every facet. I'm going to be focusing on the exciting growth opportunities, the strategic brilliance behind Meta's most recent moves, and really highlighting why I believe they're not just surviving, but thriving and positioning themselves powerfully for the future.
Indeed. While there's certainly a compelling narrative of ambition and growth surrounding Meta, I'll be bringing a crucial counter perspective. I'll be focusing on the significant risks, the substantial financial burdens that their bold bets are creating, and, well, the unproven aspects of some of their biggest investments. It's about understanding not just what's happening on the surface, but why it matters for their long-term viability and what crucial questions remain unanswered for investors and users alike, forcing us to consider, the full spectrum of possibilities.
The foundation, Meta's vast ecosystem and strategic pillars.
Okay, let's kick things off by really understanding the sheer scale and the dual nature of Meta's operations, because it's absolutely staggering. They are, without exaggeration, a true technology behemoth, developing products and services across mobile, traditional PCs, cutting-edge VR headsets, sleek wearables, and even home devices. Every single one of these offerings is fundamentally aimed at connecting people, fostering community, and enabling new forms of interaction. Their entire business is quite cleanly, yet starkly, divided into two major reporting segments. We have the family of apps, which they call FOA, and then there's Reality Labs, or RL. Now, the FOA segment is, without a doubt, their undisputed powerhouse. This is where you find their core social media and messaging platforms: Facebook, Instagram, Messenger, WhatsApp, and their relatively newer text-based platform, Threads. This is the segment that generates the vast majority of their revenue almost exclusively through digital advertising. And when you look at the numbers, they truly speak for themselves, painting a picture of immense strength. In Q4 2024, ad impressions were up a healthy 6% year over year. But what's even more impressive, the average price per ad increased by a whopping 14%. That 14% surge in average ad price isn't just a number, it's a critical signal, right? It signals Meta's growing pricing power and the incredible value advertisers continue to find in their platform, even in a competitive market. It suggests that despite privacy changes and evolving landscapes, advertisers are finding Meta's audience and targeting so valuable that they're willing to pay significantly more, effectively turning every single impression into a much richer revenue stream for Meta. This isn't just about volume, it's about the quality and effectiveness of their ad tech reaching, a new level of maturity and driving higher value per user. Then, looking at Q1 2025, their ad revenue hit an incredible $41.92 billion, marking a robust 16.3% year-over-year growth. This truly highlights their massive, engaged user base, the powerful network effects that keep people coming back day after day, and their incredibly diverse product offerings, all of which combine to provide a significant defensible competitive advantage in the sprawling digital ad space. It's a well-oiled machine driving incredible, consistent results, and it's the engine funding their future ambitions.
And those numbers are undeniably compelling, truly showcasing the power and profitability of that FOA segment, no question. But it's precisely that overwhelming success in one area that, when we connect this to the bigger picture, creates a critical vulnerability. While the FOA segment is indeed a cash cow, it's crucial to acknowledge that its primary revenue model, digital advertising, operates in an incredibly competitive, notoriously volatile, and frankly increasingly regulated environment. We all saw the significant hit they took from Apple's iOS privacy updates back in 2021, which severely disrupted their targeting capabilities. And while they've made admirable efforts to recover and rebuild, the underlying vulnerability to platform changes, escalating privacy concerns from users, and ever-tightening regulatory frameworks represents a constant and intensifying threat. So while the growth figures are impressive on their own, the deep concentration of revenue in a single, inherently volatile area, rather than diversified streams, raises a very important question. How sustainable is this reliance? Especially as new, aggressive competitors like TikTok continue to emerge and demand significant ongoing investment in features like Reels, just to maintain user engagement and market share. The diversification into other apps like Meta Horizon or services like Meta Pay and Meta Verified are steps, certainly, but they are currently dwarfed, almost to the point of being negligible by the sheer volume of advertising revenue from their core apps. The scale of dependency on digital ads is immense, and that singular focus, despite its current success, presents a substantial long-term risk.
That's a fair point about the reliance, and certainly the regulatory landscape is a constant challenge, absolutely. But I'd argue their ability to adapt to those challenges, like the iOS privacy updates, and still drive such impressive ad revenue growth, well, that speaks volumes about their underlying resilience and innovation. It's not just about market power, it's about constantly refining their targeting capabilities. And that adaptability leads us perfectly into the other side of Meta, because that's where Reality Labs comes in. It's Meta's audacious, bold bet on the future, their visionary commitment to building the metaverse. This segment is entirely focused on sculpting the next computing platform, intensely developing virtual reality, or VR, and augmented reality, AR, hardware, software, and the fundamental technologies that will power these immersive experiences. Think about products like their groundbreaking MetaQuest VR headsets, which have seen rapid evolution, including the affordable Quest 3S, launched at just $299. That accessible price point is a critical strategic move, right? Helping Meta not only maintain, but actually expand its dominance in the VR market by democratizing access. They also have the incredibly innovative Ray-Ban Meta Smart Glasses, which offer hands-free capture and sharing, integrating seamlessly into everyday life without feeling obtrusive. The fact that Meta maintained a commanding 73% market share in global VR and MR, that's mixed reality device shipments, in 2024 tells you they are the clear, undisputed leader in this emerging space, even with earlier models like Oculus Rift having contributed to their early market position. This isn't just about current revenue, which, let's be honest, is minimal for this segment. It's about building the fundamental infrastructure for the next computing platform, laying the groundwork for how we will interact with digital content and each other in the decades to come. It's a monumental, generational, long-term play, but one with potentially enormous, transformative payoff that could reshape their entire business.
And it's a future that demands a truly staggering price tag. While that market leadership in VR hardware is clear and the 73% market share is impressive in a nascent market, the financial performance of Reality Labs tells a very different and far more concerning story. When we connect this to the bigger picture, in Q1 2025 alone, Reality Labs recorded a revenue of just $412 million. That's barely a ripple in Meta's overall financial ocean. But this meager revenue came with a truly staggering operating loss of $4.21 billion. To put that into perspective, that single quarter's loss is more than 10 times its revenue, just staggering. This immense loss is primarily attributed to a decrease in MetaQuest sales, which suggests maybe a softening demand for their flagship VR product, only partially offset by the increase but still relatively modest sales of the Ray-Ban Meta AI glasses. The crucial question here isn't just about market share in a nascent market where competition is still limited. It's about the sheer scale of investment Meta is pouring into this division versus the extremely slow, incredibly costly, and frankly uncertain path to profitability.
This raises an important question that every investor must ask. How long can a company of Meta's size and financial strength sustain such massive, accelerating losses in one division, even if it's tied to a long-term vision, without it fundamentally impacting the overall financial health, the company's capital allocation strategy, and ultimately, investor confidence? The current trajectory suggests these losses are deepening, not shrinking, which is a significant and escalating concern for the company's long-term financial stability.
You've certainly highlighted the financial burden, and it's significant, no doubt. But I think it's important to see the bigger picture of their product ecosystem because it goes far beyond just these two segments. When you look at Meta's broader product portfolio, it's incredibly comprehensive and strategically integrated, spanning their classic, hugely popular apps, innovative new services, cutting-edge VR experiences, and a foundational enterprise-wide push into AI. On the app side, you have the giants that define modern digital life. Facebook, still connecting billions of people globally, Instagram for visual sharing, creative expression, and commerce, Messenger and WhatsApp as global messaging powerhouses, facilitating communication for immense populations with really unmatched reach. And then there's Threads, the relatively recent text-based social platform, which is growing fast, finding its unique niche in the social media landscape, and expanding Meta's reach into new communication styles. Beyond these core communication platforms, there's Meta Horizon, which is their evolving platform for metaverse experiences, offering a glimpse into virtual social spaces and gaming. But the innovation doesn't stop there. Their services are also expanding significantly, especially with their deep dive into artificial intelligence. Meta AI, for instance, offers personalized AI experiences, powerful image and video generation tools, and custom responses, all integrated seamlessly across their new standalone mobile app, their desktop web interface, the Ray-Ban Meta glasses, and even directly within their core apps like Messenger and WhatsApp, making AI accessible everywhere you use Meta. AI Studio provides a robust platform for AI development and experimentation, empowering developers and researchers within their ecosystem. And Llama, their large language model family, with Llama 3.1 being hailed as one of the most powerful and versatile open source models available, is at the absolute forefront of AI innovation, setting industry standards and driving significant advancements. They also have MetaPay for digital payments, streamlining transactions within their ecosystem, and Meta Verified, a subscription service designed to support creators and enhance user authenticity through verified badges and improved customer support. This entire ecosystem demonstrates a clear, multifaceted strategy of leveraging their massive interconnected user base for new revenue streams, richer experiences, and deepening their ecosystem's stickiness and utility, creating a virtuous cycle of engagement and monetization.
While the breadth of products is undeniably impressive, encompassing a vast digital empire, we need to consider the practical impact and, crucially, the maturity of each of these offerings. Many of these, outside of the core advertising-rich FOA apps, are still in very early stages of monetization or widespread mainstream adoption. For instance, Meta Horizon, which is absolutely crucial for their metaverse vision, continues to struggle with mainstream user engagement despite continuous and immense investment. It's still, a relatively niche product. Similarly, while Meta AI and the Llama family are indeed impressive technological achievements, pushing the boundaries of what AI can do, their immediate direct contribution to Meta's bottom line is still largely indirect. They primarily function by improving ad relevance and efficiency within the FOA segment, rather than generating direct, standalone revenue streams that can justify their immense cost. And this brings us back to the sheer astronomical investment required for this scale and ambition, particularly in AI. Meta is not just using AI, they are building it from the ground up, designing custom AI silicon like their MTIA V1 AI inference accelerator, which is essentially their own specialized computer chip optimized purely for AI tasks, giving them incredible speed and control. And their cutting-edge AI models, including the Llama family, aren't just powerful. They boast features like mixture of experts architecture, which lets them tackle complex problems by having different specialized AI components work together, vastly improving efficiency. They also have native multimodal capabilities, meaning they can understand and generate content across text, images, and soon, video seamlessly. And with almost unlimited context windows, they can process and remember far more information than previous models, leading to much more coherent and intelligent responses. But all of this comes at a truly tremendous cost. They plan to invest hundreds of billions of dollars in AI data centers by 2025, with an estimated 35% of their total revenue in 2025 going towards AI. 35%. This level of investment, while potentially transformative long-term, represents a very substantial and immediate short-term expenditure, and the returns are far from guaranteed. In such a rapidly evolving, intensely competitive field where technological breakthroughs can quickly shift market dynamics, it's a high-stakes gamble with a massive, continuous upfront cost that could significantly impact their short to medium-term profitability.
Deep dive into financial performance Q1 2025 and Q2 2025 outlook.
Let's shift our focus squarely to the numbers. Their operating income also climbed a very healthy 27% to $17.555 billion. This means the impressive growth in ad revenue successfully offset increases in other costs across the company, showcasing strong operational discipline. Looking specifically at the FOA segment, its operating income was an incredible $21.765 billion, a 23% increase year over year, benefiting not only from strong ad sales but also from reduced legal-related expenses, indicating maybe better cost management and a clearer path forward there. And perhaps most tellingly, their diluted EPS, or earnings per share, came in at an astonishing $6.43, significantly outperforming market estimates of $5.28, a beat that sent a strong positive signal to investors. These are not just good numbers, they are fantastic numbers that demonstrate the underlying strength, profitability, and formidable operational capabilities of their core business, exceeding analyst expectations across the board and proving their resilience.
While the headline numbers for Q1 2025 look undeniably strong, particularly the FOA segment's impressive profitability and growth, it's crucial to look deeper and consider the full, unvarnished picture. The growth in operating income for FOA, while positive, is critically juxtaposed against the persistent, widening, and frankly staggering losses within Reality Labs. In Q1 2025, RL reported an operating loss of $4.21 billion, and what's more concerning is that this loss actually widened by 9% year over year, 9% wider. This wasn't just a static investment, it indicates an increasing financial drain, largely due to increased employee compensation costs, which suggests that the investment in high-priced talent for this segment is growing. So while one arm of the company is flourishing and delivering significant accelerating profits, the other is acting as a massive, continuously expanding drain, absorbing billions in capital with very little sign of immediate improvement or a clear path to profitability. This isn't just a minor exploratory investment, it's a massive multi-billion-dollar financial commitment to a segment that is years, if not decades, away from profitability, if it ever genuinely gets there. This substantial and continuously increasing bleed from RL raises a very important question about the efficiency of their capital allocation, whether these staggering losses are truly sustainable in the long run, especially if core ad revenue growth were to slow or face unexpected, significant headwinds. It's a continuous, heavy burden on the overall financial health of the company, and it directly impacts the capital that could otherwise be returned to shareholders or invested in less speculative, more immediate growth opportunities.
And despite those very real costs, here's where it gets particularly interesting, because the market's reaction to these Q1 results was overwhelmingly positive, essentially giving Meta a strong vote of confidence. Immediately after the earnings release on April 30, 2025, Meta's stock price jumped by over 5% in after-hours trading, a clear indicator of investor enthusiasm. This strong upward movement was clearly driven by their significant beats on both revenue and EPS, along with a very reassuring Q2 revenue guidance that met, if not slightly exceeded, Wall Street expectations, signaling continued strength. By May 13, 2025, less than 2 weeks after the earnings call, Meta's stock had already risen by a remarkable 21% over the prior month, significantly outperforming the broader market. This tells us that investors are not just looking at past performance, they're very clearly buying into Meta's bold strategic vision, especially their aggressive multi-billion-dollar AI investments. The market views these massive AI infrastructure investments, which led to an upward revision of their 2025 capital expenditure forecast to a staggering range of $64 billion to $72 billion. It's a strong positive signal for securing crucial long-term growth drivers and future-proofing their business. It's a sign that the market trusts Meta to not only navigate this complex technological shift, but also to emerge as a leader, confident that these immense investments, though large, will ultimately pay off. By profoundly enhancing their core business and unlocking entirely new, transformative opportunities, the market is giving them a clear and decisive vote of confidence, signaling belief in their long-term strategy.
However, this overwhelmingly positive market reaction, particularly concerning the increased capital expenditure for AI, also raises a very important question that warrants careful consideration. While interpreted by many as a positive signal for long-term growth, it represents an absolutely enormous, unprecedented financial outlay. The company projects spending 35% of its total revenue on AI in 2025. That is an extraordinary, almost unheard of amount of money being poured into a technology that, while undeniably promising and revolutionary, is still evolving rapidly and faces intense, escalating competition from other tech giants who are also spending billions. The market's current optimism is largely predicated on Meta's ability to not only successfully build this massive AI infrastructure and develop cutting-edge models, but also, and more crucially, to effectively monetize it through new products and services, and perhaps most challenging, to maintain its leading edge in the highly competitive and fast-moving AI race. This level of investment, while certainly touted for long-term growth, could also be seen as a huge, concentrated, and inherently risky bet that might take many, many years to yield substantial tangible returns. This prolonged return period could potentially impact short to medium-term profitability and shareholder value if the execution isn't absolutely flawless, if the competitive landscape shifts dramatically, or if the technology itself evolves in unexpected directions. It's a very high-stakes gamble where the cost is certain and immediate, but the payoff is far from guaranteed and potentially far off into the distant future. It requires an extraordinary leap of faith from investors.
That faith, however, seems to be consistently reinforced by their forward-looking projections, at least among analysts. Looking ahead to their Q2 2025 earnings announcement on July 30th, the analyst community is also projecting continued strong performance, particularly for the AI-centric strategy and the foundational core advertising business. Analysts are forecasting total revenue for Q2 2025 to be between $44.81 billion and $44.84 billion, which would represent a robust 14.8% to 15% increase year over year, maintaining their impressive growth trajectory. Their EPS is projected between $5.83 and $5.84, signifying a healthy 12.98% to 13.2% growth, showcasing continued profitability. What's particularly encouraging, and a sign of increasing confidence from those who closely track the company, is that the consensus EPS estimate has actually been raised by 3.2% in the last 30 days. This indicates an increasing optimism among analysts in Meta's ability to deliver on their promises and sustain their momentum. The advertising revenue, which is their core engine and primary cash generator, is expected to grow by a solid 14.6% to $43.94 billion, driven directly by improved AI-based ad targeting and enhanced pricing power, clearly demonstrating the tangible benefits of their AI investments already flowing into their core business. The family of apps segment revenue, their profit machine, is projected at $44.46 million, and its operating income is expected to rise by a healthy 15.7% to $22.38 billion, confirming the sustained profitability and incredible strength of their core platforms. These are all undeniable signs of a healthy and growing core business, with AI acting as a significant accelerant, driving both top-line growth and bottom-line efficiency. Furthermore, Meta's own guidance for Q2 total revenue was between $42.5 billion and $45.5 billion, and the analyst estimates fall comfortably within this range, showing a remarkable consistency and predictability in their outlook, which is always reassuring for investors seeking stability amidst ambitious long-term bets.
However, let's be very clear about the continuous deepening drag that persists within their financial outlook. We have to keep coming back to this. While the FOA numbers are indeed strong and the core business continues to perform admirably, the Reality Labs segment continues to be the primary and growing financial concern. For Q2 2025, RLL revenue is expected to be only $395.82 million, a modest 12.1% increase, which is almost negligible in the grand scheme of Meta's overall revenue. But what's truly alarming is that it's projected to record an operating loss of a staggering $5.35 billion for that single quarter. $5.35 billion. This projected loss is significantly larger than the $4.49 billion loss reported in Q2 2024, indicating a widening gap in profitability despite their market leadership in VR hardware. It means the division is becoming more expensive to run, not less. And to put the sheer scale of this into perspective, the cumulative operating loss for Reality Labs has already surpassed an astounding $60 billion since 2021. To put that $60 billion cumulative loss into perspective, that's more than the entire market capitalization of some major Fortune 500 companies like, I don't know, FedEx or Marriott. It's huge. It's a staggering capital drain that, while Meta's core business can currently absorb, raises a fundamental question. Is this a calculated long-term investment or a sunk cost fallacy on a grand scale, perpetuating an increasingly expensive experiment? This isn't just an investment, it's a massive, continuously increasing cost center that lacks a clear, discernible, and near-term path to profitability, absorbing an immense amount of capital that could otherwise be deployed elsewhere or returned directly to shareholders. This truly raises a critical question. How long can investors realistically tolerate such enormous and growing losses from the RL division, especially when the timeline for return on this colossal investment remains so uncertain, amorphous, and perpetually pushed into the future? The increased CapEx, while often framed for AI, still fuels this ambitious future vision that includes Reality Labs, placing a heavy, undeniable burden on current profitability and the company's overall financial flexibility.
Strategic pillars: AI, Metaverse, shareholder value, and challenges.
That's a valid concern about the cost, a very valid concern. But when we look at their strategic pillars, here's where I think it truly gets brilliant. Meta has made AI their absolute top priority since 2024, pouring enterprise-wide resources, talent, and capital into it like never before. Their commitment is undeniable, with plans to spend an additional $10 billion on AI infrastructure in 2024, and then project hundreds of billions more on AI data centers by 2025. This culminates in an estimated $66 billion in capital expenditure for 2025, which represents, as you said, a staggering 35% of their total projected revenue. This isn't just throwing money at a problem or chasing a trend, it's a calculated, decisive move to secure a fundamental competitive edge and build a foundational technology for what they believe will be the next era of computing. They're also aggressively acquiring top talent, which is incredibly strategic in this competitive landscape. This includes investing $14.3 billion in Scale AI and bringing their CEO, Alexandra Wang, on board to lead Meta Superintelligence Labs. That's a huge move. They're even offering hundreds of millions in bonuses to poach leading AI researchers from competitors like OpenAI, Google, and Apple, demonstrating an unwavering, almost ruthless commitment to leading the AI race and assembling the absolute best minds in the field. More importantly, this isn't just a separate endeavor. AI is fundamentally strengthening and supercharging their core business. They are leveraging AI to dramatically boost ad relevance and performance, offering tools like Advantage plus Creative, which significantly improve advertiser performance and return on investment, making advertising on Meta platforms more effective than ever. This is absolutely crucial for fully recovering from the hit they took from Apple's iOS privacy updates, allowing them to rebuild and enhance their targeting capabilities in a privacy-centric world. Furthermore, AI-powered recommendations have boosted Facebook usage time by 7%, Threads usage by an impressive 35%, and Instagram Reels engagement by an astounding 24%. Those are real numbers. This isn't just about ads. It's about making their platforms more engaging, more sticky, and more personalized, which naturally attracts more advertisers and users, creating a powerful flywheel effect. And think about the untapped, colossal potential of WhatsApp. With over 3 billion users globally, it currently generates a relatively modest $1–2 billion in annual revenue. But with the strategic infusion of AI-powered business messaging and new channel subscriptions, it has a potential to generate a staggering $30–40 billion, a truly massive yet-to-be-realized opportunity. The new WhatsApp business pricing policy, effective July 1st, is specifically designed and set to accelerate this monetization, turning potential into tangible revenue. This entire strategy screams future-proofing and unlocking enormous new revenue streams, showcasing Meta's incredibly forward-thinking, holistic approach to leveraging AI.
While the sheer scale of Meta's AI investment and aggressive talent acquisition is undoubtedly impressive, we need to consider the practical implications and the very substantial inherent risks that come with such a colossal bet. Investing hundreds of billions in AI data centers and committing 35% of total revenue to AI in 2025 is an unprecedented level of capital expenditure in the tech world. It really is. This requires an almost blind leap of faith regarding future returns, as the magnitude of this investment vastly outpaces almost anything we've seen in the tech sector for a single future-focused technology. The AI talent war is also incredibly expensive, with hundreds of millions in bonuses just to poach researchers, which drives up operational costs significantly and creates potentially an unsustainable wage inflation in the long term. This ballooning cost structure could put severe, continuous pressure on margins and profitability if the anticipated revenue growth from AI doesn't materialize quickly enough, or if their AI innovations are quickly matched or even surpassed by competitors, leading to a diminished competitive advantage despite the massive spend. While AI is certainly improving ad relevance and user engagement, that's still fundamentally optimizing their existing revenue stream, making it more efficient, but not necessarily creating entirely new ones that can justify such a massive front-loaded investment in the near to medium term. The WhatsApp potential, while genuinely exciting, is still just potential, right? Not current revenue. And its full realization depends heavily on market adoption, user willingness to pay for business messaging, and the successful rollout of new business models, none of which are guaranteed. This level of aggressive spending is characteristic of a grow-at-all-costs mentality, which can be dangerous. It leaves the company vulnerable if these massive bets don't pay off as expected, or if the technological landscape shifts in unforeseen ways, making their investments obsolete or less impactful. It's a classic high-risk, high-reward scenario, but the risk side of that equation is growing rapidly.
I understand the skepticism regarding the magnitude of the investment, I do. But even with this massive AI push, Meta is unwavering in its commitment to building the metaverse, which speaks volumes about their long-term vision. Despite the Q1 2025 Reality Labs operating loss of $4.21 billion, Mark Zuckerberg's resolute plan to build a new computing platform through VR devices remains a core, deeply ingrained objective for the company. They're not just throwing money at it, they're continuously advancing hardware quality, refining the user experience, and improving accessibility with the Meta Quest series, including the more affordable Quest 3S, which strategically makes VR more accessible to a wider mainstream audience, paving the way for mass adoption. And then there are the incredibly popular Ray-Ban Meta smart glasses, which have already sold over 2 million units, demonstrating real market traction and a desire for their everyday wearable tech that seamlessly integrates digital and physical worlds. Meta maintains an undeniable, dominant 73% market share in global VR headset shipments in 2024, which means they are the established leader, actively shaping this nascent industry, influencing its development, and setting the technical and experiential standards for what comes next. They're also actively exploring future computing platforms with advanced prototypes like Orion, an augmented reality AR headset, showing they're not just iterating on existing products, but pushing the absolute boundaries of what's possible in immersive technology. Andrew Bosworth, Meta's CTO, has even declared 2025 as a decisive year for Reality Labs, emphasizing execution and craftsmanship, signaling a heightened focus on delivering tangible, impactful progress and moving beyond the experimental phase. This isn't about short-term gains or quarterly profits from Reality Labs. It's about positioning themselves at the absolute forefront of the next technological paradigm. A monumental, long-term vision that could fundamentally redefine how we interact with technology and each other, much like the smartphone did for the internet. It's a generational bet on the very future of computing, aiming to own the next major platform shift.
This continued, unwavering investment in the metaverse, despite the staggering and continuously escalating losses, is precisely where the biggest questions and deepest concerns for investors arise. It just keeps coming back to this division. Reality Labs reported a $4.21 billion operating loss in Q1 2025, and projections for Q2 2025 anticipate an even larger, more problematic loss of $5.35 billion. Since 2021, the cumulative operating losses from Reality Labs have now exceeded a truly astronomical $60 billion. This isn't just a heavy investment or growth phase, it's a colossal capital sinkhole that shows no immediate signs of shrinking. While Meta indeed maintains market dominance in VR headset shipments, it's critical to remember that the VR market itself is still relatively niche and its growth has been significantly slower than initially anticipated by many, raising serious questions about the broader market adoption and the timeline for mass appeal. Selling 2 million Ray-Ban AI glasses is a milestone, yes, but it barely scratches the surface in terms of offsetting the multi-billion-dollar losses from the entire division. It's like, as they say, using a teacup to bail out a sinking ship. The concept of building a new computing platform is incredibly ambitious. No one disputes that. But there's a significant and frustrating lack of clarity for investors on when, or even if, this massive continuous investment will ever translate into substantial, sustainable revenue or profitability. This raises a very important and unsettling question. Is this truly a visionary long-term bet with a clear path to return, or is it a classic example of a sunk cost fallacy perpetuating an increasingly expensive experiment, driven more by a desire not to be left behind by potential future trends rather than a sound financial strategy? The decisive year declaration from the CTO could also be interpreted as a high-pressure deadline to justify continued investment, rather than a clear de-risk path to guaranteed success. The financial drain from Reality Labs is undeniable, continuously growing, and places immense pressure on the company's overall financial health.
Despite these ambitious and admittedly costly investments, which are indeed substantial, Meta is also demonstrating a clear, strong commitment to shareholder value, marking a new, more mature phase for the company. And I think this is key. Starting in March 2024, they initiated a quarterly dividend payment of $0.50 per share, totaling $2 annually. This is a truly significant move for a growth-oriented tech company of Meta's scale, signaling not just their maturity, but their willingness to return substantial capital directly to shareholders, rewarding their loyalty and patience. Furthermore, Meta has been aggressively buying back its own stock, repurchasing an enormous $29.75 billion in Q4 2024 and an additional $13.4 billion in Q1 2025. That's huge amounts of capital return. These substantial share buybacks, combined with the new dividend, demonstrate robust financial health and a profound confidence in their long-term prospects. It shows that management genuinely believes their stock is undervalued and they're willing to put their vast cash reserves where their mouth is to boost shareholder returns. This indicates they are not just investing heavily for the future, but also actively rewarding current shareholders, skillfully balancing ambitious growth with direct capital returns. They are proving their resilience by adapting to intense competition, investing strategically in short-form video features like Reels to effectively counter platforms like TikTok, maintaining their vast user base's engagement and attention. They are also skillfully navigating the competitive VRR landscape against formidable rivals like Sony and Apple, proving they can hold their own and maintain leadership. This multi-pronged approach showcases a company that's both incredibly innovative, constantly pushing technological boundaries, and simultaneously financially disciplined, capable of managing complex challenges while still delivering tangible value directly to shareholders.
While the initiation of dividends and aggressive share buybacks are generally positive signals for shareholders, portraying financial strength and confidence, it's absolutely critical to view them within the broader context of Meta's unprecedented and accelerating spending habits. These actions are indeed returning capital, yes, but they also occur simultaneously with the staggering capital expenditure increases for AI and the persistent multi-billion-dollar losses in Reality Labs. This naturally raises a very important question. Are these shareholder returns truly sustainable in the face of such massive outgoing investments? Or are they, at least in part, a strategic move to maintain investor confidence and prop up the stock price despite the highly speculative nature of their future bets, rather than a reflection of overflowing free cash flow beyond what's needed for their immense long-term investments? It forces us to ask about the true source and sustainability of these payouts. On the regulatory front, Meta faces increasing, often aggressive, scrutiny, particularly in the critical European Union market. They were fined a substantial $200 million in April 2025 for violating the Digital Markets Act, or DMA, specifically concerning their consent or pay advertising model and their data combining practices, which are fundamental to their core advertising business. While Meta argues this is unfair treatment against U.S. companies and potentially discriminatory, these fines and ongoing regulatory battles represent significant operational and financial headwinds that cannot be ignored. They add immense complexity and cost, forcing Meta to fundamentally adapt its business models and potentially impacting future advertising revenue by limiting their data collection and targeting capabilities. So while they are certainly showing resilience in some areas, the external pressures from both relentless competition and intensifying regulation are only growing, creating an increasingly challenging and costly operating environment for their core business, even as they make these future bets.
The core debate, growth versus investment risk.
What truly stands out to me, and what I believe defines Meta's current strategy, is how meticulously they are building their future, refusing to simply rest on their laurels or rely solely on past successes. The massive strategic investment in AI is not just about keeping up with the industry trend. It's about fundamentally enhancing their core advertising business, making it exponentially more efficient, more targeted, and more relevant. We're already seeing tangible proof of this in their impressive ad revenue growth and significantly increased user engagement across all their platforms. That's a direct, measurable return on investment that strengthens their cash flow and secures their existing revenue streams. Simultaneously, their unwavering, almost defiant commitment to Reality Labs, despite the current losses, positions them as the undisputed leader in the still-emerging VR space. They are quite literally building the foundational infrastructure and developing the core technologies for what could very well be the next major computing platform, shaping how billions of people will interact with technology and each other in the decades to come. If this bold vision truly materializes and they are making significant strides, the rewards could be absolutely immense, cementing their dominance for decades to come, far beyond their current social media stronghold. Their dual focus on strengthening their cash cow family of apps with cutting-edge AI and boldly investing in the future of computing with Reality Labs shows a truly visionary, long-term approach, all backed by incredibly strong cash flow from their core business and a clear commitment to shareholder returns through dividends and buybacks. It's a calculated risk, yes, but one with potentially transformative upside, aiming for nothing less than long-term category leadership and defining the next era of technology.
If we connect this to the bigger picture, though, while the vision is indeed grand and the ambition is admirable, the financial reality and the sheer scale of the risks associated with these investments demand a very serious, critical scrutiny. The overwhelming scale of capital expenditure for AI, projected at 35% of total revenue, combined with the consistent, deep, and frankly escalating losses from Reality Labs now exceeding $60 billion cumulatively since 2021, creates immense and growing financial pressure. This level of spending might be sustainable in the short term due to the prodigious strength of their family of apps, which acts as a powerful financial engine. However, it represents a colossal, continuous drain on resources that could otherwise be returned to shareholders, significantly boosting investor value, or deployed in less speculative, more immediate growth ventures that could yield more certain and faster returns. Moreover, the increasing regulatory environment, particularly the substantial DMA fines in Europe and the ongoing legal battles, highlights the growing material challenges to their core advertising model, which is the primary source of funding for these incredibly ambitious and speculative bets. This means their cash cow faces escalating external threats and increased operational costs, while their future bets remain speculative, unproven, and incredibly expensive, with no clear timeline for profitability. The fundamental question isn't just if these investments will eventually pay off, but when they will, and, crucially, at what ultimate cost to current profitability, shareholder value, and long-term investor confidence. It's a high-stakes race against the clock where the finish line keeps moving further away and the bill keeps growing, forcing investors to weigh the enormous potential against the very real and immediate financial drain.
So, as you can see, our deep dive into Meta platforms reveals a company defined by immense scale, staggering financial power in its core business, and equally immense, audacious ambition for the future. On one hand, you have a powerhouse family of apps segment consistently delivering robust financial results, especially powered by aggressive, deeply integrated AI that makes their core advertising business even more effective and resilient. On the other hand, the Reality Labs division, with its bold, generational metaverse vision, continues to absorb billions in investment, shaping a future that remains largely unproven in terms of widespread adoption and, most critically, profitability.
Indeed. While Meta's core business is undeniably strong and their AI investments are highly strategic, aiming to both enhance existing strengths and build crucial future capabilities. The ongoing, significant, and deepening losses in Reality Labs, combined with the massive and continuous capital outlay for AI infrastructure, raise critical unanswered questions about long-term financial sustainability and the realistic timing of any substantial returns. The intensifying regulatory headwinds add another pervasive layer of complexity and potential cost to their otherwise robust advertising business, putting pressure on their primary revenue stream.
So for you, our curious listener, here's a thought to mull over, something to truly dig into on your own. In the rapidly evolving, incredibly dynamic landscape of technology, what computing platform do you truly believe will dominate the next decade? Will it be the immersive, interconnected worlds of VR and AR that Meta is betting so heavily on, requiring significant hardware adoption? Or will it be something else entirely, perhaps driven more by ubiquitous AI integrated seamlessly and almost invisibly into our everyday lives through devices we already use? And as you ponder that, consider, is Meta positioned perfectly to own this next era with its dual strategy, or are they potentially over-investing in a future that might evolve differently than they've anticipated, leaving them with stranded assets and unfulfilled, incredibly expensive visions?
This truly raises a deeply important question for anyone looking at the future of technology and investment. When looking at a company making such large, speculative, and high-risk bets on a future that is still largely theoretical, how do we, as informed observers, balance the excitement of future potential with the undeniable financial realities of today? It challenges us to think critically about risk, reward, and the very definition of a wise investment in an increasingly uncertain and rapidly changing world, especially when the timescales for any substantial return are so extended and unclear.
We truly hope this deep dive into Meta platforms has given you a truly comprehensive understanding, going far beyond the headlines and into the core strategies, financials, and underlying debates. We encourage you to revisit the source material we drew from, dig deeper into the numbers yourself, and form your own well-informed opinions. And remember, you can find more deep dives just like this, breaking down complex financial and technological stories, on our YouTube channel, Market Insightcast.
Before we go, please remember that all information discussed in this deep dive is based solely on the provided source material and is for informational purposes only. Investment decisions carry inherent risks, and any investment judgment or decision-making responsibility rests entirely with you, the individual investor. Furthermore, please be aware that while this deep dive is meticulously crafted from the source material provided, information generated by AI tools may, on rare occasions, contain subtle differences or inaccuracies. Always conduct your own thorough, independent research and consult with qualified financial professionals before making any investment choices. Thank you for joining us on this deep dive.